Thanks so much for tuning into Alpha Moguls, a show where we speak to some of the finest investing minds about what is their portfolio approach and arguably what have the last 12 to 18 months taught them about what's new that they can do in the portfolio. Our guest today, on I must say, popular demand, is Sumeet Nagar of Malabar Investments. Sumeet, so good having you. And the number of people who asked me to get you on air is pretty large. So I'm glad that we are talking today.
No, good to be on the show, and thanks for reaching out and following me. Always happy to have a good conversation.
Thanks, Amit. So let's start off that good conversation by talking about whether you've changed your portfolio approach in any fashion. You probably used to have reasonably concentrated bets, because I remember you telling me that unless you get a sizable part in of your money into a company, you don't want to take those very small bets. Has that changed? Have you had to do a lot of churn in your portfolio because of the fast changing landscape? Can you talk a bit about what the portfolio approach is currently?
Sure. So I think the portfolio approach, making concentrated bets, I think that continues to remain, because if you're too diversified, your performance would resemble that of the market, right? So if you want to outperform, you need to make concentrated bets, and the whole notion that if you never have all the ideas of same quality with the same level of conviction. So you ought to put most of your capital in your highest conviction ideas, right? So that approach continues to remain the same. Having said that, with size, there are challenges in terms of deploying capital into small and mid-sized companies. So it does result in sort of building positions slowly over a period of time. But the idea is to eventually get them into a concentrated phase. So our portfolio, so if you look at the top 10 or 15 positions, would always have more than 75% of capital, right? So that's a very concentrated approach to investing. On your second part in terms of churn, see, our view always has been to be that of a long-term investment. So we invest in a company with a long-term horizon. We're supportive of those companies. We know that companies, never move up in a straight line. So there are periods when they face challenges, and we want to be supportive. If anything, those things give you opportunities to add, along the way. Having said that, as you pointed out, over the last year and a half, you've had such, violent movements in the market. First on the downside, then on the upside. And those movements were not uniform, right? So you found certain set of opportunities that moved first, certain set of things that moved later, and so as a result, it is incumbent upon you as a fund manager to see where do you see the best prospective returns, not in the near term, but again from a 3 to 5 year perspective, where is the best prospective returns, and to ensure that you allocate capital to those. And sometimes as a result, you have to be very disciplined about taking capital out from some ideas, which honestly are good companies and good ideas, right? But the challenge as an investor is not to differentiate between good ideas and bad ideas. That's very easy. The challenge is to differentiate between good ideas and great ideas, right? And that's where the real challenge is. And very often it's not just about the companies, right? It's also about how these landscapes are evolving, how these companies would grow, what is that runway for growth, what is their current valuation compared to the intrinsics. So it's not easy to prioritize or sort of characterize them in sort of good, very good, and great. So you have to make a lot of subjective calls. It's not easy, but just because it's not easy, it doesn't mean it's not important, right? So it is very critical that you relook at the portfolio, ensure that even the companies that have done well for you on a prospective basis, are they able to give you the best returns possible? And if that's not the case, then answer that tough question on where you can allocate that capital.
Okay, so I'm guessing you've taken a fair degree of churn. I'll get to the nuts and bolts of the themes in a bit, but have you changed the allocation based on the belief of whether in what looks like an increasingly volatile 2022, possibly, maybe there is safety in larger caps versus mid caps and small caps? or are you still betting as heavily at the broader end of the spectrum?
So, we have always focused on small and mid caps, and so we don't invest in that area because it's topical today, right? Or because we think that over the next 1 year or 2 year, it will give us better return compared to large cap. The reason why we focus on that space, and I'm not saying that this works for everyone, but there's a rational case for investing into small and mid caps, and that's threefold. So number one, smaller companies just have the ability to grow faster, right? They can grow faster than larger companies, and it's just the law of large numbers, right? Larger companies can't grow percentage-wise as fast, and that's what gets reflected in the performance. So if you take sort of most 5-year period and pretty much any 10-year period, you'll find that the small and mid caps would outperform the large caps. Obviously, they're more volatile along the way, right? But over that, if you have that long-term investment horizon, then actually investing into small and mid caps works, right? But because they're more volatile, you have to be a bit more sensitive about where in the cycle you are, what valuation you're investing in. But that's true about any equity investing, right? That you have to be mindful of that. But it's just a little bit more acute in the case of small and mid caps. But the longer your time horizon is, the less important the entry or exit valuations become. They're still important, but they still matter, but not as much, right? So that's number one reason that over long periods, small and mid caps outperform. That's why we invest in that. Number two is that there is a lot more inefficiency in the small and mid caps compared to large caps. And it is possible to find some great companies at fairly reasonable valuations, just because there's not enough research done on them, or if it's done, it's not done in depth. And the true appreciation for quality in those businesses is not apparent. And so that inefficiency as an active investor is what you can take advantage of. And number three is sort of your temperament, the longevity of your capital, and the skill sets that you have as an individual or as a team. If it's geared towards that in-depth research that you can do on your own, you're not relying on somebody else, then this combination actually works, right? So again, as I said, it may not work for everyone, but we believe that for us, with the longevity of capital that we have, with the long-term approach that our team has, we can actually unearth these inefficiencies and find some great ideas to invest in the small and mid caps.
The last 18 months were months which ushered in a lot of changes to themes which could have been multi-year themes generally. So there were some disruptions, some temporary, some permanent, Sumeet. Did you have to change your thesis in some themes because of what COVID-19 ushered in? What were the key things that you thought were forever changed and therefore you had to change? I mean, just hypothetically saying, somehow the view on technology or IT services for a lot of people changed quite materially because of what COVID-19 has done, and admittedly for a bunch of other businesses as well. What stood out for you over the last 12 to 18 months that forced you or that led you to make changes?
Yeah, so I think what we saw during COVID period is that besides the disruption, I think that there were not really new trends that came up. It's just the trends that were already taking place. They were brought forward and they got accelerated, right? So, for example, the adoption of technology, right, or adoption of sort of e-commerce or digital transactions. I mean, these were trends that were already happening before. They just got accelerated during this period. And so, for example, I've mentioned this in the past, right? Even before COVID, we had 2 or 4 significant investments in companies like Apple or IndiaMart, which were technology-led businesses. And it was surprising to us how they took a hit, immediately post-COVID, because our assessment was that these companies would be able to navigate this change quite well, if not actually benefit from that, right? And so as a result, in those immediate months of March, April, and May, our biggest find was in companies like those where we felt that the disruption is actually beneficial to these companies, and yet, like everything else, they corrected by the same 30, 40, %, right? So that was the inefficiency in the market that was available back then. Similarly, if you think about sectors like specialty chemicals or electronic manufacturing or so forth, right? These trends were anyway taking place, right? It's just that during that disruption, and I think in case of specialty chemicals, I think most companies around the world realized that they had an unhealthy level of reliance on China, and they needed to diversify away from that. And in sectors like specialty chemicals, where you need a well-entrenched value chain, right? You need feedstock coming in, which becomes input into something else, and byproducts of that become input to another company. Unless you have that entire ecosystem, you can't compete in that. And other than China, there's no other country which has as wide an ecosystem as India has. So when people are looking to diversify away, which by the way, they were already doing for the previous 3, 4, or 5 years, that trend just got accelerated in the last year and a half, right? And so that's what we witnessed during this period, that nothing new per se, but the trends, what would have taken you sort of 4 or 5 years has started to happen in 2 or 3 years.
Wow. Well, did you make adequate use of technology for your basic research, Sumeet? I remember you telling me that maybe 25 days of a month, you are on the road in the dustiest of villages trying to understand from management's firsthand and dealers, etc. It would have been impossible in these COVID months. So what have you changed in your basic background research as a company, as a fund, that maybe even others can do? Can you give some insights here?
Yeah, so honestly, I think that's the one part of our work that we missed, quite a bit during the past year, and I'm glad that it's restarted, to some extent. I think because the feel that you get of companies and their ecosystem and the suppliers and distributors and dealers, meeting them face to face is just different from doing it remotely. Having said that, I think the one thing that we learned quite well is that using technology, you can supplement or augment what you can do in person, right? So while in-person visits, you can only do X number of them in a day, and you should do that. But then you can use technology to reach out to a lot more number of people to get a broader and diversified opinion, right? So we started to do a lot more of that, during the past year. We started to find sort of data sets, industry-specific data sets that you could analyze to understand sort of what was happening. So again, sort of use of technology and what you can do remotely. And I would say that those things are welcome changes. Some of those will actually remain, right? So I think while we welcome this, opening up of things and being able to travel and meet people in person, some of the things that we've learned in the last year and a half will continue to remain with us, and that's actually a good thing.
Yeah. Okay, so let me try and dwell upon a few themes based on my assessment of where you might be overweight, underweight, etc. We obviously can't talk about the whole market, but since we started off with technology and you gave us some insight into you buying some tech-enabled platform-related businesses, maybe, which have you. But let's split this up. Can I start off with the bread and butter basic IT services? There is a large demand. The valuations have skyrocketed though, and growth is looking very good for some, looking okay for some others. Where are you on this argument for IT services? Because some of the smartest people that I've spoken to are split right down the middle. Some are extremely bearish and some are still extremely bullish.
Yeah. So I'll start with the caveat that we had never been big investors in IT services because we felt that this is really not a platform play, right? It's, so there are businesses where economies of scale can be hugely beneficial. In services, you don't get that, right? So what you want to see in the platform businesses, the great thing is that each piece of incremental business beyond a critical mass doesn't add to your cost. And that results in accelerated return on equity and capital. That doesn't happen in services. And so with that bias in mind, I would say in the early stages, we did, look at this space. We did make some investments Happiest Minds was sort of the most important one that comes to mind in that phase. Um, but it may be the case that the trend has run. If you look at IT services over very long term in India, right, it has sort of followed the cyclical pattern. While there should not be much of a cyclicality to the business, but if you look at the valuations, they've always followed that cyclical pattern, and that's because the growth beyond a certain level becomes difficult. I think in the last 1.5 years, people have seen how much dependence the world has on technology, and as a result, the need for IT services is sort of in your face. But the level of growth that you would see there is still limited, right? And it doesn't lead to that accelerated return on capital. And I'm sure people are able to find good ideas in that space, but we find that there are other places where we can get better return on our investment. So we've not been focusing on that.
What about the other technology pieces then? There is, again, this whole debate about whether it makes sense to bet on the path to profitability versus buying an entrenched player, because profitability will come as it came maybe for Amazon, maybe for some of the others. Help us understand your thinking behind the new age consumer tech companies or whatever, fintech, what have you.
Got it. So, we do believe that in businesses which are winner takes all and where there's a clear winner, it's incumbent upon that winner to keep expanding the market and to become more and more entrenched. And if that results in sort of higher deployment of capital up front, then that's a rational thing to do, right? But all of that starts on that big premise up front. Is this a winner take all? And is the company you're betting is really the winner? If the answer to those two questions is correct, and yes, then you could perhaps take the path of saying that you can defer the profitability for longer. But in vast majority of the cases, the answer to those two questions is not a yes, right? And then it just becomes an easy excuse to invest in companies that don't really have a path to profitability and to justify a higher valuation. So I would say that in our case, our overwhelming preference has been to invest in companies that have clearly demonstrated profitability. And yes, we know that we're missing out on certain opportunities as a result, but that conservative approach has done extremely well for us, right? So, the two tech examples that I mentioned to you, Apple and IndiaMart, both have been highly profitable businesses, and yet they've been able to deliver growth which is far above what the overall market is delivering, and many technology companies are delivering, right? We also had invested recently in a company called Truecaller, which everyone in India knows about. They've used the app, but the company is incorporated in Sweden and got listed there, even though 70% of their business actually comes from India. But it's a phenomenal business. Its user numbers are only behind that of Facebook and WhatsApp. If you look at their gross profit generated, it's higher than most other consumer technology companies in India. And because it was in Sweden, where people didn't understand the value proposition, it was available at a very reasonable valuation. Right, so that's an example of a company that's doing extremely well. It's a consumer company, internet company, and yet it's highly profitable. So our bias has been to find companies like that and invest in them, and that way you're not taking the risk that eventually at some point you wake up and you realize that either the company continues to need the funding to grow, or the market starts to value them differently.
So in effect, you will not bet on the Indian consumer tech companies as they are right now, because, well, the few of them which might have some bit of profitability are priced at FY25, 26 valuations as well. So you are rather looking at consumer tech maybe, but in other geographies. You want that good value at a good profit kind of thing.
I think that's the preference, right? I mean, you always want to make sure that you're able to buy something at a at a discount to its intrinsic value, right? And so this notion of price is what you pay and value is what you get is a very important one. And while I have no doubt that over the course of next decade there'll be some great winners in the internet economy in India, but I think you have to be careful in terms of the valuation at which you're investing in. And I would say that there is probably some time in future where you may be able to find these companies at least at a better valuation, if not an absolute price, right? So I think you just need to be a little bit patient in terms of pursuing that. But if you do reach this assessment that there's a company which is in a winner-take-all market and is a clear winner, then maybe it's actually, if you do your work and if you can actually justify the valuation based on the future value, it is a worthwhile bet to take.
Yeah, I guess so. Okay, which brings me to the next theme, and that is financials. Now, there has been incessant FI selling in the last, well, probably the whole of this financial year, but more so the last 3 months, right? I mean, we're doing the math, northwards of $11 billion or thereabouts. Financials obviously have taken the brunt, and therefore that's the big taboo sector to invest into right now. What's your sense here, Sumeet? Largely large cap, but a bunch of mid caps which are up there trying to do something different, and the advent of fintech, which might disrupt this space as well. How are you approaching investing here?
Got it. So I think, as investors, you have to be always forward-looking, right? And so you have to visualize the world, sort of 12, 24 months, down the road. Obviously, if you look back in the last year and a half, as you pointed out, the financials took the brunt of what happened as the borrowers' earnings capacity got impacted, their repayments got impacted, the growth was not there, the asset quality was affected. So for a whole host of reasons, financials have taken it on the chin, and that's what is getting reflected in the market. But if you look forward that 12 to 24 months to an environment where COVID is hopefully behind us, in that environment, these companies, the growth can resume. I think as it is, you're seeing with inflation coming back, the demand for credit is increasing, and as the demand increases, you would see the top line of the companies continue to increase. There is a sense around the world that the central banks are being very cautious in terms of increasing interest rates, and so as a result, the cost of funds should continue to lag the demand or interest rates in the market, so the spreads can remain healthy. But the biggest hit that companies have taken, financial companies, was in terms of the provisions they have to take, right? And that provision in a post-COVID world, or in a world where people have sort of learned to live with COVID, should not be there, right? That's a one-time impact. And so profitability of many of these financial companies can improve quite substantially. And so that's, the sort of case, the rational case that you can make for investing in financial companies that have been beaten down. But even more interesting than that is that there are companies, they mentioned about the mid-sized companies that are differentiated. And if I may take an example from our portfolio, is a company called as Aptus. Aptus Value.
Yes, please do.
Yeah, so Aptus Value Housing Finance. And again, this time, we've owned this company for the last several years. But this is a company that in FY21, I mean, think about FY21, it's probably the worst year that I can think about for financials in the last many, many years that I've seen. In that environment, Aptus was able to grow its earning by 40% year on year. That's a phenomenal performance in the face of a very, very tough environment. And, if you look at their financial numbers, if you look at their ROAs is north of 7%, very limited leverage, this company can grow its earnings by 25% compounded for the next many years, right? They got listed in, about a quarter ago in an environment where, there was a lot of sort of public listing. There's maybe an IPO fatigue to some extent. And because there's a general, pressure on financial, it hasn't done much. But if you look at the fundamentals, like the only two companies in India that I can think of, financial companies that have had fundamentals comparable to this is Gru Finance and Bajaj Finance in the past, right? And you've seen sort of how those companies have created value for their shareholders, and we think that Aptus has the ability to do something like that. And because there's a overhang on financials, it's not getting reflected in price. But as they keep delivering their numbers, if nothing else, at least you can see a 25% sort of appreciation in their earnings that should get reflected in price.
And suffice to say, therefore, that you believe home finance is probably that area within financials that you probably believe can have the best bang for the buck, because I mean there's a lot of other facets that are now coming to the fore: consumer finance, there's gold loans, and a bunch of others. You believe home finance could be it?
So I would say that with a caveat, right? So if you're thinking about your normal home finance, like if you were to go out and get a home loan, there'll be 20 lenders out there, lining up to lend to you, right? And obviously when that level of competition comes, it becomes very difficult to earn margins that are significantly above what the market is delivering, right? So if you are a mid-sized player in financials or an NBFC or HFC, right, you have to operate in spaces where you're not competing with banks, right? Because banks have cost of funds that you cannot compete with. So you need to operate in areas where banks find very difficult to operate in. And affordable housing finance is one such area, right? So when you're talking about lending to a local painter or a local mechanic or a kirana shop, right, where you may not have tax returns, right? You may not have a prepared balance sheet and cash flow statement. That is an art, right? And Mr. Anandan, who founded Aptus, has 3 decades of experience in doing that and has done it so superbly well that in their decade-plus history, they've had 0 loss given default, right? There is hardly any financial company that can boast of a record like that. And so I think it's because they have a skill set to underwrite these very well. They underwrite these very conservatively. So their typical loan to value at the time of lending is about 50%. On the book basis, it'll be probably just over a third. And so that's a very conservative underwriting, right? And if you're able to do that consistently well, your cost of funds is lower compared to competition, your spreads are high, your asset quality is superb. I mean, they ended FY21 with GNPA of less than 1%, right? Most home finance companies had numbers much higher than that.
That's true. Okay. So bottom up, very, very bottom up, as opposed to having a top down approach out here too. Okay. Which brings me to the next pocket, Sumeet. And you referred to it briefly, specialty chemicals. Now it's a story that is now no longer a nascent story. It's unfolded very well. There have been sparkling winners over the last 2-3 years, at least, if not more, actually over the last maybe 5, 7, 8 years. And yet, when I talk to managements, some of them at least say that there is a next leg of growth coming in because of this whole China plus one thesis, which was happening and has gotten accelerated post-COVID. Give us a sense of whether, if you are fishing in this pond, are you looking at companies with, I'm sure you're looking at companies with differentiated capabilities, but are you definitely looking for companies which have got a valuation comfort as well? Or are you comfortable buying companies which may have fabulous products, but are still trading northwards of 40, 50 times? Because it's across the gamut, this whole pocket.
Yeah. So I would say, luckily for us, we'd been looking at this theme for some time. And I said, I think this was a theme that was there pre-COVID as well, and it just sort of accelerated. And so many of our bets in the space, we've made in the early part of that journey at valuation levels that thankfully were, much more attractive compared to where you see them today. Having said that, right, I would say that while in the near term, maybe the returns could be muted because the valuations are high, it's really always about the long term, right? And we believe that in specialty chemicals, you're seeing this trend unfolding, which is a very, very long runway, right? And because it's an ecosystem play, right? Because I think India is getting more and more advantage. And once you have that, it becomes even more difficult for somebody else to replace you. And so you'll find more and more companies coming to India to look for alternatives. Once they have comfort with that, they will sort of double down on that. And we see that trend to continue for next many years. So just like IT services sort of started in the 90s, Y2K sort of gave it a fillip, and even 20 years later, it's running on strong legs. We think that specialty chemicals similarly sort of started, 3, 4, 5 years ago. It's sort of gotten a momentum because of COVID. It has a long runway, right? And if you can find those differentiated players, right, who can take advantage of this trend, right, can keep expanding the addressable market and compound at a high enough rate for the next 5 or 10 years, then you can still generate very good returns in those select companies from the levels that we see today. And so I think it's when you see the kind of appreciation that you've seen in the last year, you have to become even more discerning in terms of where is the true quality, which are the companies that have that very differentiated offering that allows them to keep compounding or keep going for the next 5 years, 10 years at a pretty high level. And if you can find companies like that, then it is worth investing in them. And again, it's not that you would put all of your capital in those or all of your investment in that today, but you can start building your positions in companies like that.
Just one quick follow-up. I'm guessing from your answer that you're still invested out there. And at times you find just one name, which is great. At times you find 4 or 5 and you choose the great from the good. My question to you is, do you believe that the space has enough and more good companies from where you have had to make one of the better choices, or are there fewer names now because of the valuation run up and the fact that some of them might be operating at optimum capacities, etc., etc.?
Yeah, so I think the truly differentiated players are getting valued highly as a result of what has happened. But again, I think it's really about not what you see today, but what these companies could become 5 years down the road, right?
But that will always be the case in every sector, right? Sumeet, I'm sure you invest in every space.
It's there, but when you are investing at high valuation, it becomes even more acute, right? And the growth rate that you need to sustain the current valuation just becomes that much higher. So can you conservatively underwrite that, right? What is the visibility that you have? What is the comfort that you have? Have you spoken to customers who are saying that, listen, I'm willing to give more orders if the company had more capacity, right? Are you seeing clear plans in terms of adding capacity down the road, right? And if you see, are you seeing tangible evidence of them expanding their addressable market by getting into other areas where they have right to win? So if you can find things like that, then yes, you can still justify either investing or holding onto those positions. But in our view as long-term investors, quality is always very important, right? So you want to be with companies like that, but you want to make sure that you're investing at a valuation which is reasonable given the growth profile and capital efficiency that these companies have.
Got it. So one final word, and that is on a bunch of these new age themes that have come up now. Since you mentioned electronic manufacturing, I'm guessing you probably would have looked at the PLI beneficiaries, but that's now been in 18 months. But there is also this whole EV theme unfolding and the related benefits to some spec chem companies, to some other companies. There is this, yesterday the whole semiconductor policy, even though we're not really direct beneficiaries, but what have you. So that is the other thing. Suddenly India's awakening, or the government's awakening to the fact that textiles is such an inherent strength that let's do something for the sector. So it's almost like a rebirth. So a bunch of these recent themes have come up in the last 12, 18 months. Have you fished in that pond? Do you like something specific in terms of themes from there? Can you talk a bit about how are you going about choosing companies from these newer themes?
Sure. So I think I think the PLI schemes have obviously provided a very strong impetus to domestic manufacturing, and I think they've been reasonably well thought through. And if you think about most of the sort of Asian countries, right, that have succeeded well in exports, they've done on the back of similar sort of schemes that came up in those countries. So even though belatedly, I'm glad to see that we're seeing this happening in India as well. So I think, look, our approach has been to look at at sectors where there is a reasonable level of domestic demand, right? And the demand is growing quite well, especially if that's leading to import substitution, right? That's a very easy theme to bet on, right? And once you create enough scale, with that, then you can start to become competitive in exports as well, right? So electronics manufacturing is, example, of that. And so we had invested, again, sort of post-pandemic in Dixon, that's, that did quite well. More recently, we invested in a company called as Expro. Again, it's sort of a derivative of electronics manufacturing. So Expro makes these really thin films that you metallize, and it becomes the dielectric material that goes into capacitors. And capacitors go into pretty much any electrical or electronic application that you can think of. And as the demand for electronic manufacturing in India is continuing, they are a clear, beneficiary of that. Moreover, when EVs start to come through, the capacitors that go into EV are significantly larger, and the dielectric materials you need them is also significantly higher. And the demand for that is so huge in India today that even at this stage, Expro, who's the only manufacturer of this film in India, is catering to only about a third of the demand. Right? And so there's even if they double their capacity, they would still not be able to meet the existing demand in the country. And the demand itself is growing quite rapidly, right? So again, if you find examples like that, where there's already enough market in India, there is a clear import substitution theme. Once you sort of capitalize on that and your cost bases become quite good that you can compete in the exports market, that's a great place to be in.
Okay, so you are in effect or looking at indirect beneficiaries in order to play this theme, even if there aren't, or even if there may not be too many direct beneficiaries, but you are fishing in the newer ponds and the emerging areas that have come up in the last 12, 18 months.
So. That's a great part of being in our investing business, right? That you're always learning new things, right? And that's excitement. I mean, the reason why most of us do what we do today is that we can find companies like that. The thrill or excitement of unearthing something that you didn't know about, yesterday. I think that's great, and that's what keeps you excited, and that's what gets you to the office or gets you on the road and learn about these companies and industry. Right?
Awesome. So, before we wrap up, one final question is on things that were a trend or were a very strong trend. Some of those played out, some of those didn't. I want to understand, how have you looked back at some of things? So, for example, the whole consumer trend, and you've spoken to us in the past about luggage manufacturers, about book distributors. I think chemicals were a part in one of those conversations as well. Where have you seen things? It may or may not be a part of your portfolio, by the way, but where have you seen, or even in the past, but what I'm trying to understand is, where do you see or where do you assess that things have changed, wherein the market believed that this was a trend getting formed, but somehow it hasn't maybe quite played out as well as people would have thought?
Yeah, so I think, you see that happening in many cases, right? Where when a new trend starts, I think people believe that this is a very powerful trend, and there's temptation of extrapolating significally, comes in, but the reality comes out different, right? So again, I think we've seen cases after cases where people say, oh, per capita consumption of XYZ is so low in India, right, compared to other countries. But I think on that metric, pretty much you can show pretty much anything and say, hey, this has got a huge potential, right? But that doesn't make it an investable opportunity, right? Even for we, for example, invested in automotive quite a bit over the years, but we go with an open eye. I think people say that, oh, China is manufacturing 25 million cars, we're only producing 2 million, we're going to go to that. No, you can't go to that, right? Look at the landmass, the size of China, look at the density, look at the road system. So I think you have to temper those assessments by what is the ground reality, right? And on that basis, you can still make an educated estimate of where the future would be, and make investment with those realistic assumptions, right? And if things don't pan out as you anticipated, you keep reevaluating. Right? I mean, that's a part of investing. I think what we talked about earlier. You have to, always introspect, right? What you've done, what has worked out, what hasn't worked out, and if it hasn't worked out, whether it's short term or long term, right? If it's structural change, then you need to correspondingly sort of reform your views.
Yeah, that's true. Well, Sumeet, this was lovely. It's been a while, but it was worth the wait. Thank you so much for joining us on Alpha Moguls, and to you and family, have a great the year ender and a super 2022.
Thanks very much. It was great to be here and enjoy the conversation. And happy holidays to you, family, and all the viewers as well.
Thank you so much, and viewers, thanks for tuning in.